Welcome to the Opening Bid Podcast. I'm Yahoo Finance Executive Editor Brian Sozzi. Like I always say, this is the podcast that will make you a better investor and, dare I say, a better leader. Now, one of the most popular people on our platform, especially YouTube, that is, it is Ray Dalio. You all in the Yahoo Finance community have consumed millions of, minutes of times when Ray Dalio would come on. So essentially, you've asked for this interview. I somehow got this interview with Ray Dalio, Bridgewater Associates founder, here at the World Economic Forum. Ray, it's a real treat to see you in person.
It's a treat to see you and be on your show.
I think the last time I talked to you was in my ex-girlfriend's kitchen during the pandemic. It was so weird, Ray. Like I'm defrosting meat and then I'm talking to you. I think you may have been in overseas somewhere. So it's wild.
Isn't it great?
It is great. So there's a lot of different places we can go. I want to start a new book because I'm really captivated by the title, How Countries Go Broke. Why? What made you write the book? And what's the state of the U.S. debt situation?
As you know, I'm a global macro investor, and the most important market in the world is the U.S. Treasury market. And there's not a good understanding of the mechanics, the cause-effect relationship, like simple questions. Does it end? Is there no limit? What is the limit? How does it work? This has happened repeatedly through history. So there's simple mechanics that people have to understand and numbers. And it's more important right now because we're turning the year, and the first big issue, and it's one of our biggest, maybe the biggest threat, but certainly one of the biggest threats, is the supply-demand for bonds that relates to the Treasury bonds. So when we get into it, I'll explain some thoughts. But the reason I wrote it is, can we agree on the mechanics? And since I've been for 50 years an investor in all countries' bond markets, I've been through most of these debt crises. I think I know something about the mechanics, and I wanted to lay it out.
What message, is this book, or what are you trying to tell investors in the equity market? How concerned should they be about America's debt situation?
A lot. Okay, first of all, everybody, most fundamentally, has to understand that interest rates, and the most important interest rate, the Treasury rate, has a big effect on markets. Am I telling anybody anything? Okay. And the most important influence on that is the supply and the demand of that, right? So if you're looking at the supply of it, and what it's projected to be, what it will be. It's going to be about, under the existing deficit, it'll be 7.5% of GDP. There's a demand. So the first thing I want to say is you must look at two things. You must look at the supply and the demand. So when I think, I've been through many of these, when I think, I calculate how much supply are we going to have, and then I look at who are the owners of it, the debt, around the world, and how much are they going to buy. And I go through that supply-demand issue. You also have to understand how the debt cycle works. When debt is accumulated, we already have a lot of debt and we're adding to it at a fast pace. When it's accumulated, it itself creates debt service payments. If you take the interest rate times the amount of debt, that is the amount that you have to pay for servicing debt. And that debt service crowds out other spending. The way I look at it is credit is like nutrients, and it's almost like the bloodstream. And the system carries this credit that gives you the buying power. And that credit passes through the system. If that credit, which then turns into debt, produces an income that is greater than the debt service, everyone benefits. If it's less, they don't. If it's less, it starts to accumulate, like the blood in the arteries are going through, but this debt accumulates. And it accumulates almost like plaque in the system. And because you have to pay more and more of that debt, so it squeezes out the credit flow. And as a result of that, that can squeeze out it creates problems. When you get to the part of the cycle where you're borrowing money to pay the debt and the debt service, it is a self-reinforcing spiral. We are there. We are on the edge of that. And I don't think it's understood. So my main goal is I've put this out. Anybody can, it's free online. Anybody can read it. Does it make sense? Are we clear? And we are at a moment in the first half of this year. We are at a moment where the budget deficit is going to be dealt with, and it's very clear what must happen.
Let me just go there. Does the extension of President Trump's signature tax cuts, does that create a moment of distress for the U.S. economy? I'm hearing what you're saying. How do we're piling more debt on top of more debt? I mean, doesn't that break the system?
Yes, it in terms of supply and demand, I'm going to take the tax cuts or how we get to the deficit. I'm going to put that aside for a moment. Whatever the deficit is, however we create that, that means that debt has to be sold to finance it. So if you today look at what the size of that is, and you look at the buyers of that debt and the owners of that debt, we are on the brink of a major problem, I believe, supply demand. Okay, now if we take the numbers and you take the tax cut, if the tax cut is rolled forward as it's expected to be, the deficit will be 7.5% of GDP. If it's not rolled over, it's estimated that'd be 6% of GDP. So 7.5%. So that's a lot of debt that has to be sold. The number must be cut to 3% of GDP.
It's a huge cut. Entitlements are cut.
I'll get there as to how you cut it.
Yeah. Well, you got me fired up about this topic. Like, I'm just doing the math in my head too,
right.
As I'm listening to you.
So there are three ways that the deficits get cut. But yes, it's a significant amount. But we did that in 1991 to 1997. It can be done in a healthy economy. It can be done in a healthy economy. So the number to look for, the mantra, the pledge, I believe policymakers should say, is 3% of GDP. Make it 3% of GDP. However we get there, we can talk about the different ways. One of the biggest problems, I think, is everybody argues about the ways, which stands in the way of getting there. So there should be a pledge. 3% of GDP, okay, and you can get there. Now, what are the ways? Of course, everybody thinks of taxes and spending. Taxes are also, there's tax rates, and that's not necessarily the same as tax revenue. So there's tax revenue that matters the most, and then there's spending. And number three is there's interest rates. The interest rate impact on the deficit is greater in terms of potential changes than even the amount of cutting of spending or the raising of tax revenue, because there's so much debt. And so the debt service costs are a lot. So if they cut spending, or in one way or another, they could do it all in spending, they could do it all in taxes. I don't really care how they do it. I mean, that's more importantly is that they do it. I shouldn't say I don't care, but I'm saying they should stop arguing I don't really care. The important thing is you do it. It would be somewhere between 4 and 5% of each. If you do it in one, and then it has to be more than if you don't do it in the other. If you don't change, let's say, taxes, then you have to do it more in spending. And so you have to look where. But the number three is the interest rate. And if you can cut the deficit like this in good times, you're going to get a beneficial fall in interest rates. So and monetary policy can work with it, because if you're having a fiscal tightening, which is depressing for the economy, in a sense it's a negative, but it reduces debt. it can also be met with a monetary easing to lower that debt service. And so they both serve to reduce the deficit, but they have opposite effects. One is more restrictive, negative on growth and inflation. One is more positive on growth and inflation. They can work together. But if you don't do that, and we also have a bad time in the economy, we will be in an impossible situation.
I think a lot of average investors are going to listen to this and they're going to say, wow, Ray Dalio is really bringing up some very important points in the country's financial position. If they own a lot of stocks, should they be preparing for a pullback in markets this year?
I think the market looks quite like it did in 1998. Okay, so we'll talk about the stock market. The stock market is many different types of companies, and now it's very much a function of the pricing of particularly certain types of tech stocks. You know, the segmentation, yes. The segmentation of the market. Mm-hmm. Those companies have now gotten a lot more expensive. And like 1998, they're wonderful companies. They're going to have a fantastic futures in various ways. We don't know who the winners will be, but their prices have gotten expensive. One of the important things to distinguish for any investor is distinguishing a good company or a great company from a price, the great price. You can buy a bad company at a great price and you'll make money, and you can't buy a great company at a bad price and make money. So the price matters. So now you have a situation, here we are, very similar, that the prices of those that have been leading this market are relatively expensive, and you could have an interest rate increase.
Which is not a good scenario.
We've seen this scenario before, right? I don't want to take responsibility for telling, I'm not meant to be an investment advisor, and particularly things can change. I will say that the important thing, if you're building a portfolio, is to know how to have excellent diversification, to not be systematically leverage long. Most of the world is leverage long right now, but to pay attention to this issue with how the debt goes, because it'll matter.
Hang with us, Ray. We're going to go off for a quick break. We'll be right back on Opening Bid. All right, welcome back to Opening Bid. We're at the World Economic Forum in Davos, Switzerland, having a just a special chat with Bridgewater Associates founder Ray Dalio. We're talking about valuations. Do you agree with Jamie Dimon that valuations on stocks look inflated right now?
I think it depends on what stocks. Yes, the leading stocks, the market as a whole, they're expensive. I think that, for example, the superscalers, the Magnificent Seven and so on, have become expensive, and that there's opportunities in the next in AI will come in applications and the using it, and who will use it to change their course and have big impact. I think it's very much like the internet and the dot-com period. It's very much like that. So yes, it's relatively expensive. And yes, if you have an interest rate rise when it's relatively expensive, it's not likely to be good. And so that is where it is in terms of these great companies. And I think rotation is the important consideration. And what concerns me is so much of your focus and so much of the focus on stocks and those things, and rather than building a well-diversified portfolio. I'd say my concern about bonds is clear. And then I think also alternative money. What is the alternative money? Gold? Is it going to be Bitcoin? Is it going to
meme coin?
Okay. But to think about how to have diversification. My mantra in investing, if you follow this mantra, if you achieve this mantra, you will make a fortune. It's your holy grail. It's my holy grail. 10 to 15 good uncorrelated return streams that are risk balanced. The power of diversification. Everybody's thinking about what is the best bet, and they don't realize that with diversification that way, the first three diversified, relatively uncorrelated assets will reduce the risk almost in half. So that means you double your return to risk ratio. The game is played on not getting out. You know, the nature of losses, here's the nature of loss. You lose 50%, you have to make 100% to get back. So it's a risk return game. And so if you know how to put that diversification, and it's very sensitive to interest rate changes. So those are the things I'd like to emphasize.
Making great points here, Ray, on interest rates. Then do you think the 10-year pushes past 5%? I mean, where do you think the 10-year 10-year yield, a bond yield?
Yes, I'm worried that if we don't get close to that 3% number, we're going to have a supply-demand problem. And I think it could be significantly higher than the 3%, 5%. Look at the market action. It's indicative. Market action, long-term rates going up while short-term rates are touted to go down, easing of monetary policy. It's a supply and demand issue. And so then the question is, if there is a supply demand issue, does the Fed and other central banks around the world, we're seeing this happen in the UK, we're seeing it happen in France, we're seeing it happen in different places, that market action I'm talking about. In other words, when rates rise, led by long rates, when the central bank is inclined to ease, and then you see currencies go down, particularly, let's say, in relation to gold or your relation to other, and the Bitcoin and so on, it's a supply-demand issue.
I talked to Bank of America CEO Brian Moynihan too as well. We talked about the outlook for Fed policy. He couldn't rule out a potential Fed rate hike this year. I'm like, that's interesting.
Right.
What happens? What happens if we do get a surprise rate hike?
I think it's all the supply demand. What raises the supply? If the long rate is rising, and then you have this selling of bonds and so on, the French federal banks, because all of them it's true for, they will have a choice. And if you get it, I mean, combined with the pricing of assets, then PE multiples go up, expected growth rates of earnings and economic activity goes down. And you know what those cycles are like.
Some of the things you're laying out here, to me, make a case against the dollar and for the need of Bitcoin as an alternative currency. Am I way off base?
I think we need to think about what is the alternative currency, because all currencies have this issue. Debt is currency and currency is debt. So what I mean by that is, when you're holding debt, you're holding promises to receive currency. And what that currency is worth depends on the supply and whether they print it and so on. When you're holding currency, you're holding it in the form of debt. So we have a situation where we have too much debt. We have too much of it, and we're producing it at a fast pace. So we have to think, looking at history, what is the alternative money? And money has two purposes. It's a medium of exchange and it's a storehold of wealth. So yes, we have to think about alternative monies. And by the way, this is not individuals who are just thinking about it. These are countries and central bankers who are thinking about it. The changing in the holdings of bonds and debt as an asset, and the buying of gold and other assets in terms of the mix is a reality.
I want to leave enough time in this podcast to get some more evergreen type thoughts from you. One of them being, how can one, if they had $1,000 today, how can they go upon becoming a better investor right out of the gate? Or a good investor?
The most important thing is realizing that competing in the market, there's alpha and there's beta. What I mean by alpha, I mean are you beating the players? Competing in the markets to produce alpha is more difficult than competing in the Olympics. You wouldn't think to yourself, I'm going to go compete in the Olympics. But there's more people chasing after it, and it's a zero-sum game. Alpha is a zero-sum game. To get alpha, you have to take it away from somebody else, right? Beta means there's an asset class. Okay, so first, be humble. Second, diversify well, because you don't pay a cost for the diversification, but you have to know how to risk balance your investments to diversify well. This is key. Be humble, or like in any game that you're competing. Also, get away from the notion that investments which have done well recently are better investments rather than more expensive. You have to know the difference between an investment that it's gone up a lot and it's done well.
So NVIDIA can be expensive. I mean, I think everybody's obsessed with this company.
This is another problem. It's supply demand. Who's overweighted and why? You know, these memes, when it ever becomes, everybody believes it.
It's time to head for the gates, right?
Yeah, right. And so be humble, be diversified. Don't assume that because it felt good recently and gave you good returns, it's a better investment. These are the basic fundamentals.
I want to lean into some of your leadership teachings before we let you go with the principles. There's a lot of leaders here on the ground thinking about how AI is impacting their workforces, but at the end of the day, they're still managing people. What mistakes are leaders at big companies or even small ones, what are they still making in terms of mistakes here today? And how can they improve and drive a more efficient workforce, a more enlightened workforce? What do they need to do?
The most important thing is to know what people are like and how they're different. There are different personality types. There are different skills. There's values, abilities, and skills. Values are the most important thing. Why are you working? Abilities means, let's say, you have the ability to be a great something or other, great skier, great investor, whatever, but that you haven't been trained, you don't have the experience. And then there are skills. When you're creating an organization, these things have to be brought together, and you have to have what I would say is meaningful work and meaningful relationships. Are you on a mission together to do great things? And at the same time, this meaningful work, that mission, and then meaningful relationships. How does that work? And related to that is knowing how people are different. Their minds think differently. Personality profiles, when you think about like Myers-Briggs, I started with Myers-Briggs tests and others. I created, by the way, an online for everybody to take. Take this, Principles U. It's free. It's an online personality test. It'll tell you how you think. And when you look at others and they take the test, how do they think? To respect those differences, to know that thinking different, it matters, and knowing how to put those different ways of thinking into a team so that others who can do things that you can't do are in the team, and to create an idea meritocracy. So it all comes down to two things: people and culture. What are the people like? Not only their skills, their values, and also how they think. And then what is the culture like? I believe that an idea meritocracy in which the best ideas win out. So my mantra was I want an idea meritocracy in which there are meaningful work and meaningful relationships through radical truthfulness and radical transparency. In other words, can I share with you what I think in a non-hierarchical way? Can you share with me what I think? And together, can we get at the best ideas and let the best ideas win out? These were things that would be important. So when you think about it, what is your culture? What are you like? What are the people like? How do they fit together? It's a machine.
I want to quickly dip real quick into opening bid overtime, because you actually came up at a dinner I was at here at WEF the other day. And we were talking about radical transparency and implementing it into one's culture. How do you do that? How do you go from being a leader worried about what HR might say to being radically transparent, and then maybe that leading to better outcomes for your organization?
Well,
because this leader I was talking to,
first of all, on HR, the leader and the owner of the organization has to decide what they want, and then of course they have to do everything legally. So HR is not determining that. Then it's really the barrier is in the human barrier. People have been brought up and instinctually they don't like to hear certain things, and they are afraid of speaking up. And that creates a barrier. So the way that I think is important is to say to somebody, would you like me to share what I think so that we can discuss it and you can reply to it because I'm thinking it? Would you rather me tell you and discuss it or not? The intellectual brain will say yes. The emotional brain might have a problem with that.
You're scared.
But you want the intellectual brain to realize this is a better thing. And when it's both ways, I want you to do the same with me. I want to give you the freedom. I don't want it to be hidden in your mind. And so if we have that deal, that we understand that and do it carefully and almost ask permission, and realize analytically that it's better that we know what we're thinking so we can work things out in a way, that's a much better approach. So the answer to your question is making it intellectually a contract. And I watch people go through it. It takes between a year and 18 months to get adapted to it. And not all people get adapted to it. My experience is 65, 70% of the people after about 18 months wouldn't want to do it any other way. Because they go into organizations and they watch everybody sort of high-five each other and everything and talk behind each other's backs and criticize behind each other's backs. Like I had a rule, if you're saying something critical behind somebody's back, you do that 3 times, you're out. Because it's useless. If it's a real problem, let's discuss it. So you need the intellectual realization of it. And if people have that intellectual realization and then they get used to it, they won't want it any other way. And it works because when you find out what's true, you know how to deal with it. If you don't know what's true, you don't know how to deal with it.
You can tell me what you think of me off camera. Not right now. Let's just save that for another time. But this is a real treat. It has been too long since we talked to you. Don't be a stranger.
It's a pleasure.
You're always welcome on Yahoo Finance. Ray Dalio, Bridgewater Associates founder, just really making our trip here at the World Economic Forum. We appreciate a love for opening bid. Please hit us with those likes all over the place, YouTube, Spotify, all the major podcast platforms. We appreciate the comments, appreciate the feedback. And you know what? In the spirit of Ray Dalio, we appreciate the radical transparency, because I will go out there and improve this podcast every single time. And that is it for the latest episode of Opening Bid.